Hey, good morning, Isaac.
Good morning.
You and me, huh? So far, just the
I
two
guess
of us.
so.
We'll see how this. We'll give we'll give your classmates a minute or two. Um, if we don't get anybody in the next couple of minutes, we'll just go into the lecture and get the first class done. This first chapter is very basic and is not a long session, so we'll get through it. Are you in Santa Barbara, Isaac?
No, I'm in Fullerton right now.
Where?
I go to Fullerton.
Oh, are you going to? Or do you go to four-year school up there?
Yeah, I go to Cal State Fullerton.
Oh, okay. Great. All right. Well, we'll see what happens here. We'll wait another minute or so. Ugh.
So I saw like if people don't join the live lecture, you send them a recorded lecture. Is that correct?
Yes,
Okay.
yes. I'll send them this lecture unless I think uh, I got a better one saved. But yeah, and Cornelia will put it into Canvas for your convenience. Go from there.
All right.
Okay. What do you say, Isaac? You want to get going here? We'll go through this.
Yeah, sure.
Yeah. Hold on now. Share. Okay. You see the slides, right, Isaac?
Yes.
Okay, that's a good start. All right, here we go. Introduction to Accounting. That's our course here, chapter one. Here we go. We got somebody else here.
Hi,
Hi
good
there. How do you
morning.
put Nastaya? Is that how you say your name?
I say my name Anastasia.
Oh,
Oh,
Anastasia.
or Nastia. Yeah, Nastia is just a shorter version, but Anastasia is probably easier.
Okay, Anastasia. Great name.
Yeah,
Was a
thank
great
you.
was a great queen in Russia,
Yeah, I know, I know.
Tsarina. Okay, we're just getting going. We may not have anybody else show up, and that can happen once in a while. Here's Niels. Hi, Neil. How you doing?
Hello, how are you?
How do you pronounce your name? With the S?
Yeah, Nils, Nils.
Nils. All right. Okay, we got Isaac and Anastasia, Nils, and you're on your way to extra credit, which the others will not get. So we'll get going now. It's little lift was about 103. Okay, here we go. Chapter one. We're in introduction. We're gonna be talking about this a little bit. The purpose of accounting. The purpose. Hey, Anastasia, good to see you. The purpose of accounting. It provides financial information to people who want it and need it. Individuals, agencies, organizations. We're going to talk a little bit about who wants to see this stuff. Four areas here we can talk about just to get going. The owners of the business, guess what? They want to know if the company is profitable and they're in a good current financial position. The owners are thinking long term macro. If the business is good, maybe they can hire more people, make other investments. If business is not doing good, they might want to dig in themselves and find out what's going on. So, the ownership, of course, managers of the business, a sales manager, perhaps, a production manager, they really have an interest in the financial statements because they may have their bonuses tied to it or commissions. You're a production manager and you're going to get a bonus if you minimize rejects in the factory or you sell enough in your store. So the managers need information, not detailed information, but what affects them. So owners and managers and creditors. Creditors. A creditor is a lender. A creditor is a lender. A bank is a creditor, for example. Nobody is going to loan your company a dime unless they see well prepared GAAP audited, attested financial statements. Creditors, lenders, they want to know that your company's profitable. They want to know about your debt structure, how much you might owe now. And they're really interested in the assets you might have if things go south. So lenders absolutely want to look at your financial information. These are your customers. Who uses this stuff? And of course, you've got government agencies, talking specifically the IRS. They certainly want to be able to dig into your business and make sure you're paying the appropriate amount of taxes. So these are just some of our customers who need financial information. They get into some steps here they call the accounting process. And I guarantee on your test, they ask about you'll get two or three multiple choice questions, perhaps, about these steps. Accounting, what we start with is we gather financial information about a business and eventually report this information. We're going to record transactions, transaction, anything that affects the company financially. So we start with analyzing something, looking at events that have taken place and how they might affect the business. This can be very complicated or super simple. For example, you work in a small business and the electric bill comes in the mail today. You open you open up the mail and there's the electric bill, $300. Well, you look at the 300 and maybe you look at last month and the month before, and you make a determination that the 300 seems reasonable. And in that example there, you're done with your analysis. It can be super complicated if it involves buying another business or something, or opening up a new store. Analyze. Once you've analyzed, you record the information into your accounting system. And when we get to chapter 3, you're going to learn all about journal entries, which are the mechanisms for getting this information into your accounting system, or the general ledger, if you will. Once we record it, we want to put it into the right category, sorting and grouping similar items together. For example, we want to have all the expenses that affect the sales department in one block of numbers. We don't want to mix up the salaries of the salesman with those of the executive officer. We want to classify things correctly. And of course, we're going to always try to summarize, aggregate, meaning bring together many similar events to provide easier to understand information. Once we've done these 4 steps, now we report. We're telling the results. That's what we're talking about. Those are going to be your 3 financial statements. You're going to be hearing a lot about the income statement, the statement of owner's equity, and the balance sheet, and maybe the cash flow statement. These are the basic reports people expect businesses to provide. And then where the accounting people really get busy is in the afterward, interpreting what just happened here. Our budget said we should have done $1 million in profit, and we only did 900,000. What happened? What did we do wrong? What can we do going forward? So these steps here, I don't think you need to memorize these steps because they kind of go in a logical order. We analyze, record, classify, summarize, etc. Here are 2 mnemonics you're going to hear quite a lot: GAAP and FASB, GAAP, generally accepted accounting principles. And I guarantee there'll be a question on that on the test. These are the rules of accounting. These are the rules that tell you when you can record a sale, when you can record an expense, when you can do this or that. And these rules come from the American Institute of Certified Public Accountants via their Financial Accounting Standards Board. The Financial Accounting Standards Board. These are the people who are always meeting, and they're looking at how the world is changing. Is this accounting rule outdated and perhaps needs to be changed? Or there's some kind of blowback from people that there's certain information not being generated. The accounting principles, the procedures, and the guidelines to be followed in the accounting and reporting process. And you're going to hear, in the workforce, I used to hear this once in a while. You'd be trying to figure out something. You hear somebody say, oh, that's not GAAP, not GAAP. You have to follow the GAAP. Process used by FASB. Well, what do? They identify an issue and they put it on their agenda and they research it and they do preliminary reviews and they might have public hearings. Boy, that must be exciting, huh? These public hearings on some accounting, come up with an exposure draft, just a report that what the anticipated impact might be. And they issue a final update. And now you have a new GAAP rule. Maybe I can make it a little more interesting by talking about a GAAP rule that was changed not that long ago. It used to be department stores, we'll say, Nordstrom's or Target, whatever. Department stores used to sell gift certificates to people, the gift cards, which we all get. And those stores, as soon as they sold that card, that was income to them. It was income, even though maybe the card was never used. People get a card for $20 and they put it in a desk drawer and forget about it for a while. So the FASB people said, that's not real logical accounting-wise. And they held these various hearings. The rules have changed now. Stores like Nordstrom's, they have to estimate how much of their sold cards are not going to be used. It's obviously based on their prior history. It has an impact on the store if the card is used or it's not used. So that was an example of a rule that was changed where this becomes an expense to the company. They have to record that no one's going to be using, some people are not going to be using the card. Believe me, there's nothing stores hate more than people who don't use the card. It sounds like easy income for them, but they want people to come to the store with that card because I think most people are like me. If I get a $100 gift certificate to Target, there's no way I'm walking out of that store spending only $100. And the stores know that. You're going to spend $150 or whatever. Anyway, that's just an example of an accounting rule that was changed fairly recently. We're going to get into a quick look at different types of ownership structures. If you've taken Introduction to Business at the school, you know this probably as well as I do. We're talking three types of ownership: sole proprietorship, partnership, corporation. Sole proprietorship, sole, one owner, and that owner makes all the decisions. That owner is a king. That owner assumes all the risks. That owner reaps all the profits if the company is hopefully successful. Sole proprietorships are by far the most common type of business in the United States. Sole proprietorships, they're the backbone of the economy. There's a lot more sole proprietorships than corporations or partnerships. The problem with a sole proprietorship is the owner assumes all risk and their personal monies are at risk. What we're talking about is this. You open a company with $10,000. You put $10,000 in a new bank account and you call it the Anastasia Company. And at the end of the year, the business didn't do too good. And you now owe $100,000. You lost $100,000. That money is going to come out of your personal funds. Personal. There's personal liability with the sole proprietorship. There's no corporate shield, if you will. So at the end of the year, if you owe $100,000, you can't just throw up your hands and say, well, I only put $10,000 in the business and I'm going to declare bankruptcy and walk away. It doesn't work that way. You have personal responsibility. The lenders, creditors, they can come and garnish a paycheck. They take your car, things like that. Partnerships.
Real quick question.
Yeah, sure.
I just wanted to check which lecture this is for. Are we going through for 240 or 110?
This is 110, right?
Okay, I just wanted to check because the 240 syllabus has lectures from 10 to 11 Monday, Wednesday, Friday. And so I wasn't sure if there's
wow.
misinput in like when it is.
I just assumed it was 110. Hold on. Hold on a second. That's a darn good question.
So I wasn't sure. I thought at first it was just review. And so if it is 110 or 240, I just want to make sure we're doing the right thing.
Oh, for heaven's sake. Hold on. I'd much rather be teaching 240. That's more interesting, right? Okay, hold on, Nils. That's what you were expecting, right, Isaac? 240?
Yes.
Oh, for heaven's sake.
Yeah, 42.
Okay. Boy, the semester's off to a good start, huh? Okay, let's do this. I'll do the right lecture right now, and then I'll trim the video if I can and get it out to you guys. I'm so sorry. I'm a little embarrassed here. Okay. So you guys are saying to yourself, can you see the slide now for 240? No?
It's still on 110.
Okay, no problem. Fix that right here. There it is, 240. Okay. We all see that? You see that, right, Nils?
Yeah, can see it.
Okay. You will be tested on the 110 questions, though. No, I'm only kidding. All right, here we go. Managerial accounting. This is what we used to call cost accounting. We're dealing in managerial accounting with a company that builds a product. And they have to keep track of the labor and the materials they use and the overhead. Managerial versus financial. Financial accounting is concerned with reporting information to external parties. External, kind of like we just talked about in 110. We're going to do financial accounting reports for the external people, the lenders, the shareholders, whatever. Managerial is more focused on information to managers within an organization for planning purposes, to control the operation, make a decision. And you just heard me babbling about GAAP. A lot of the reports you're going to be doing in managerial are not GAAP approved, but they're most useful for the company to take a good look at itself. And they're giving you some differences between financial accounting. And the main thing is financial accounting is external. Managerial is for internal. You would very, very, very rarely send the public your managerial type reports because that has proprietary information in it. If you're doing a report, for example, on the profitability of a product, that's nobody's business but your own. External, internal, financial, what happened here, we're looking at the future more. Emphasis on objectivity, we're talking about relevance. So you kind of get the idea. I'll let you look at this here. The rules must follow GAAP, not bound by Mr. GAAP. And the financial accounting for external, that's mandatory. You have to do that. You must do that. And managerially, you don't have to do anything. Types of course classifications. What we're going to learn about pretty soon, and this chapter gets into some pretty good detail as we start quickly. We're going to learn about assigning costs to objects and using these costs to predict cost behavior, make business decisions on top of the financial accounting. Now, hang in there with us. We're going to talk about what you're going to realize are very basic terms, and you do the homework. You look the chapter over, and these things will start to sink in. You're seeing them for the first time. We have what are called direct costs, indirect costs, and common costs. Direct costs that can be easily traced to a unit of product or another cost object. Direct cost, what the world calls raw material or direct material, and direct labor. I drink too much of this whiskey here, the Diet Coke. This bottle cap is a raw material. It is a direct cost. Every time my company, Coca-Cola, puts that bottle cap there, that's $1 of direct cost. A direct cost is traceable to the item, to the object. It takes an hour to screw this thing on. That's $20 an hour. That is a direct cost of what's called direct labor. So direct costs, they only are incurred when there's an activity. They are only incurred when there is some kind of production activity or sales activity. You have indirect costs. We have material and labor. They are 100% direct, or as you'll see, variable. These costs go right into the product. Indirect costs are those that can't be easily traced into this bottle of soda. Things like the supervisors, perhaps, in the factory, the security guards, supplies, depreciation, the rent on the factory building, fringe benefits. You get the idea. Those are called manufacturing overhead items. And your total cost is always going to be expressed as MLO, material, labor, overhead. And we'll learn quite a lot on how we get the janitor salary into this bottle of soda. Common costs are indirect, and they might cover a number of different items. They can't be traced to any individual cost object. Depreciation may be on the factory, rent, insurance, something like that. So we have direct and indirect costs. Material, labor, overhead. Remember that, huh? Direct material. These are the items that become part of the product. Here they're talking about a radio installed in an automobile. Yeah. But this car also needs steel it needs rubber, it needs glass. All of those things are raw materials that can be traced directly to the car. This car needs 3,000 pounds of metal. They need 4 tires. They need 5 panes of glass or whatever, direct or raw materials. Direct labor. These are the costs of the people who are actually building the product. A lot of times it's called touch labor. These are the people who are bolting on the tires. These are the people who are painting the car, inserting the glass. Direct labor, traceable to the individual car. Manufacturing overhead is this netherworld of different kinds of costs. Manufacturing overhead, all manufacturing costs except material and labor. That's one way to look at it real quick, huh? Material, labor, overhead is your total cost. So any manufacturing cost that is not direct material and direct labor would be your overhead cost. Overhead cannot be readily traced to the finished product. We're talking about things like indirect materials and indirect labor. For example, you're building a car, you're a guy who works on a car, and every once in a while you need to lubricate the machine you're using. Well, that oil, those lubricants, they don't go into the car, but it's a necessary expense for some materials, right? We call those indirect materials, cleaning supplies. Cleaning supplies. Wages paid to employees who are not directly involved in production, let's call them indirect labor. Your supervisors, janitors, security guards, maintenance people. You might have some engineers that are always walking around. So we have direct costs in the overhead, in indirect labor material, and indirect labor. Some examples of overhead: depreciation, utilities, property tax, insurance premiums. Obviously you can't get the electric bill and say 2% of this electric bill goes to these cars. It doesn't work that way. There's a method to do that, which we'll be discussing fairly soon. Only those indirect costs associated with operating the factory are considered manufacturing overhead. You have utility costs to keep the factory running, the electricity in the factory. That is classic manufacturing overhead. But 10 miles away are the offices of the, say, the accounting department. Those utility costs have nothing to do with manufacturing overhead. We're going to call those period costs. They have nothing to do with the material, labor, or overhead, nothing to do with the manufacturing. Manufacturing costs can be classified. Again, we have our famous material, labor, and overhead. And when we get to chapter 4, we're going to learn about something called process accounting, process costing. And there, they take the material and labor, combine it into something called prime cost. Material plus labor, direct material, direct labor equals something called prime cost. The direct labor plus the overhead cost, we're going to call conversion cost, okay? Conversion cost. Non-manufacturing costs. I just use an example of the accounting offices. Well, non-manufacturing, and this is very similar to what we learned a little bit in 230. You had cost of goods sold, which is your material, labor, and overhead now. You're learning in 230, the cost of goods sold was what you paid for the garments you sold. You bought a dress for $100. You sold it for $500. The $500 is the sale, and the $100 is the debit to cost of goods sold and credit to the merchandise inventory. Here, just like in 230, we're breaking out the selling expenses and the admin. Non-manufacturing are simply the selling and the admin. Selling costs to secure and deliver the product can be direct, can be indirect. A commission is certainly direct. There is no commission expense unless you have an activity, meaning a sale. Admin costs, this is the executives and the clerical and the personnel group, human resources. These are nearly all indirect costs. There might be some bonuses involved that would be considered direct. Period costs and product costs. Well, whether you realize or not, that's what we've been talking about. Product costs, material, labor, and manufacturing overhead. Everything else is what we call a period cost. Period cost. Start with the product cost. All the costs involved in making the product or acquiring the product. These costs attach to a unit of product as it's manufactured, and they stay attached to each product, each unit, as long as it's sitting in the inventory awaiting sale. The cost of this bottle cap is, say, $1. That cost is going to stay with that bottle forever. They attach. What are the manufacturing product costs? For those of you who might have missed it, material, labor, and overhead, but we have different inventory categories. So let's look at this. Manufacturing company product costs are reported in 3 different types of inventory: raw materials, work in process, and finished goods. Raw materials. When we bought these bottle caps, maybe we made these bottle caps. We bought 1 million pounds of moldable plastic. That's a raw material. Any physical item that goes into the finished product. Raw materials. Raw materials are moved eventually to an inventory called WIP, work in process. These are units that are only partially complete and need more work before they're ready for sale to the customer. Work in process. Well, we got the wheels on this car, but we haven't put the engine in yet. Work in process. And then, of course, finished goods. These are the items we have produced and are now available for sale. So what we're going to be seeing as we get into perhaps the next chapter is you're going to learn we bring raw materials in, we debit raw materials, credit accounts payable, I guess. We move the raw materials to the floor, to the factory floor. We're going to debit WIP and credit the raw materials. And then when the work in process items are finally completed, we're going to debit finished goods inventory and credit the work in process. That's the flow. That's the flow. And again, product costs, material, labor, and overhead. I think we kind of got that now, huh? Product costs, they are material, labor, and overhead. And what are we doing when we incur those costs? We're building inventory. Period costs, simply selling and admin. Non-manufacturing, selling and admin. These are expenses that go directly to the income statement. Product costs don't end up in the income statement until when? Until you've sold the product. Period costs are recorded as an expense as you incur them. We got a question here. Which of the following costs would you call a period cost as opposed to a product cost? Well, let's look at it. Manufacturing equipment, well, as soon as you see the word manufacturing, you know that it is a manufacturing or product cost. As soon as you see taxes on corporate headquarters, you know it's a period cost, because the property taxes on our corporate headquarters, which are across the country somewhere, have nothing to do with manufacturing. Raw materials, certainly manufacturing. Electrical cost, if it's on the factory. So if there's a God in heaven, B and E are the items that are a period cost. Period cost. Has nothing to do with making the product. We incurred the expense now, and we're going to record it now. In this course here, it's all about cost behavior. In 230, we, and in 110, even 110 and 230, we gathered costs toward a department, or we gathered costs to a total for the income statement. Here, we're more interested in the behavior of the cost. They must behave. The most common classifications: variable cost, fixed cost, mixed cost. And you need to know these like the back of your hand, and you will. Not terribly difficult to get the concept. It's working within the parameters that would get a little tricky. So let's see what we got here. Variable cost. Wow, a cost that varies. That's clear. That clears things up, huh? This is a cost in direct proportion to the activity. The activity. Variable cost. There is no variable cost unless there's activity. Again, this bottle cap costs $1. If this company made one bottle during the month and that's all, their total material cost would be the $1. If they made two bottles, it would be $2, etc., etc. A variable cost has this linear behavior where it's incremental. And when we talk variable cost, we are almost always talking cost per unit. Variable cost, no activity, no variable cost. Variable cost per unit is constant. Now you have this cell plan here. The cost per text is 5 cents per text message. If you don't send any messages, there's no cost. But every time you make a phone call, it's going to cost you 5 cents. Cost per unit, 5 cents. The activity base. I want to see something here. Okay. The activity-based cost drivers, they're kind of getting ahead of us here. Let me skip this for 1 second. I think this one is out of sequence. Yeah. Believe me, somebody slipped this one in here by mistake, okay? Ignore it. Fixed cost. Variable cost, you're going to see that line going up incrementally at a 45-degree angle. Fixed costs are those that remain constant regardless of the activity. In your phone example here, you may have to pay them X amount of dollars every month before you even get charged for a phone call. Those are fixed costs. Fixed costs do not change based on any activity. If a factory shut down for a month and sent everybody home, they still have a lot of remaining fixed costs that don't go away. They still have to pay the rent on the building. They still have to pay the insurance policies. They still have to pay the security guard, whatever. Fixed cost is the same going across. Variable costs, we always talk per unit. Fixed cost, we always talk in total dollars. Total dollars. And here's kind of why. If we express a fixed cost per unit, that per unit cost is going to vary with the changes in the activity. The average fixed cost per cell phone call made decreases as more calls are made. And they're taking something that's pretty simple, making it sound a little more perhaps complicated than it should be. It just means this: if the fixed cost is 1,000 and you only had one activity, well, it would be 1,000 per activity. If you had 100 activity, the fixed cost would go down to 10, etc. So we very rarely talk about fixed costs per unit. It's not a meaningful thing to review. Types of fixed cost: committed and discretionary. Committed, these are long-term things, and we cannot significantly reduce them in the short term. Business is losing money and management's running around. We have to cut cost. Well, there's a lot of things that are committed, and we can't cut them in the short term. Again, I go back to the rent on the building, your insurance policies, your depreciation. You can't reduce those with just a snap of a finger like you can with discretionary. Discretionary, meaning you have discretion, you have a choice. You can alter these in the short term. You can get rid of the security guard, for example, something like that. You can cut back on buying supplies, lubricants, whatever. Committed discretionary overhead costs. Not going to worry about the relevant range. It just means that we have a factory, and this factory can make 1 million bottles of soda a year. That's the range we're going to work with, that range of 1 million. I guarantee you're not going to get any questions about the relevant range on any tests. But here's an example of it. The relevant range affects both fixed and variable. Assume office space is available at 30,000 per year, and we can only get it in increments of 1,000. The relevant range is that 1,000 feet for that amount of money. If we go beyond that, the fixed cost would increase at a rate of 30,000 for every additional $1,000 of 1,000 square feet. The relevant range would go from 1,000 to 2,000. The fixed side, it just means that the relevant range is this line right here, whatever the fixed number is. So let's not worry about the relevant range too much. Let's compare cost classifications about behavior. Behavior. Variable costs increase and decrease in proportion to the activity. Variable. A commission is classic variable. You sell a car and you get a $500 commission. You sell one car, you earn $500. You sell two cars, you've now earned 1,000. Variable costs are constant per unit. And that's important to think about and have that fundamental in our back pocket all the time. Variable cost per unit is always the same. The bottle cap is always $1, always $1. Fixed costs, as we know now, are not affected by change in any activity. Fixed costs per unit go down as the activity goes up, but it's just a meaningless thing. Fixed costs are not affected by changes in the activity. And fixed costs, we're always going to address them in the terms of total cost, not per unit. Which of the following costs would be variable with respect to the number of ice cream cones sold at Baskin & Robbins? There may be more than one right answer. I've been known to go to Baskin & Robbins now and then. The variable cost, the cost of lighting the store, the wages of the store manager, The cost of the ice cream, the cost of the napkins. What do you think?
C and D.
There you go. Yeah, C and D. The cost of the ice cream. Every time you make an ice cream cone, you're scooping out 4 ounces of chocolate or whatever, and you're handing the customer a few napkins. You only have that cost take place when you sell some ice cream. Lighting in the store and the wages of the store manager, well, they're going to be fixed. That stays the same. It's not going to change with the activity. We're going to get involved quite a lot with what's called a mixed cost. A mixed cost. Such a cost has a variable element and a fixed element. And there's a lot of analyses we'll be doing where we need to compute the variable portion or the fixed portion. A good example we just saw with the bill from your phone network, where you paid $100 a month just to have the phone, plus 5 cents per phone call. So a mixed cost is going to have the fixed element and the variable element, and everything above this line is your total mixed cost. Now, they make this a little harder than it needs to be. The mixed cost can be expressed as an occasion. Y equals A plus BX, huh? Y, total mixed cost equals A, the fixed cost, plus B, the cost per unit, times the number of activities, the level. If you're a kind of a math nerd and you like the y equals A plus bx, that's fine. But I encourage the students to think of it this way: total cost equals fixed cost plus variable cost. And the variable cost is always going to be the units times the activity. So a mixed cost has fixed and variable elements. If your fixed monthly utility charge is $40, you must live in a very small apartment, huh? $40. Your variable cost is 3 cents per kilowatt hour, and you consume 2,000 kilowatt hours. What's your total bill? Well, you're stuck with the 40 no matter what. 2,000 times 0.03 is $60. So
$100.
What's that?
I just say $100.
I'll let you guys answer them from now on. I've made a lot of mistakes when I go too fast. I go, and your answer is 200, and 100 pops up, and here we go. Cost classifications for decision making. And a lot of these terms we're going over will really get hit hard in the appropriate chapters going forward. A lot of the work in managerial accounting involves alternatives. Should we make this product, or should we buy it from an outside party? Should we open a new store or not? Should we close an underperforming store or not? Decisions involve choosing between alternatives, obviously. The goal of making decisions is to identify the costs that are relevant or irrelevant. And we have a whole chapter just on this. You have to know 3 concepts, not too hard. Differential cost, sunk cost, opportunity cost. Differential cost, that's simply the difference between your 2 choices. A difference in revenue, we'll call it a differential revenue, difference in cost, differential cost. I went to 7-Eleven, I spent $3 for this jug of soda. I could have gone next door to Starbucks and spent $8 for a fancy cup of coffee. The difference in cost of $5, that's a differential cost. That's one thing we need to understand. A sunk cost. This is just what it sounds like. It's money that's already been spent, and we can't change it now or in the future. We invested in that formula for low-calorie pizza, and it didn't work out. We lost our entire investment, a sunk cost. Sunk cost, money that's already been thrown away. What's important to know about sunk cost is going forward, you must ignore them when making a decision. When you're making a future decision, that sunk cost money is gone. You've already spent it. It's human nature, though, to say, we don't want to throw good money after bad because you're burned by that bad investment. You're going to learn very clearly they're ignored when making managerial decisions. Opportunity cost, that's the benefit that is given up when one alternative is selected over the other. I bought my $3 bottle of booze here. I didn't take the $8 at Starbucks. That $8 was the opportunity costs. And these costs are not found in the accounting records, of course, but they're relevant in any decision you make. What is the opportunity cost you incur by attending class? Opportunity cost. What is the potential benefit? What is the opportunity cost you incur by attending class? You can think about that a little bit. The potential benefit that's given up. The opportunity cost might be you could have gone right into the workforce and made some money. That would be an opportunity revenue. Suppose you're trying to decide whether to take the train or drive to Portland to attend a concert. I think we have to know if it's Portland, Maine, or Portland, Oregon. Huh? Anyway, be silly. You have cash to do either, but you don't want to spend more than you need. Is the cost of the train ticket relevant? In other words, should the cost of the train ticket affect your decision whether you drive or take the train? Anybody want to shout out yes or no? You afraid of that one, huh, Anastasia? Of course it's relevant because we're going to compare the cost of the train ticket against the amount of gas or whatever we're going to incur if we drive. Suppose you're deciding to drive, again, same thing, but this time you have an annual cost of licensing your car. Is that cost relevant in this decision? No, because that's money you have to spend no matter how many miles you drive. So you're going to get a whole chapter on irrelevant versus relevant decisions and what makes them relevant or irrelevant. You can sell your car right now for $5,000. Is that a sunk cost? No. Remember, a sunk cost is money that's already been spent. We sunk it. We sunk it. Okay, now we get into something really good. We have our traditional GAAP income statement, which we use for external reporting, which you learned about starting in Accounting 110. Sales minus cost of goods sold equals gross margin minus selling and admin gets us down to net income. That's what we've learned. In this course here, we're going to be doing a lot of work with what we're going to call the contribution format, the variable format, if you will, contribution format. Take a look at this now. Sales minus variable expenses equals what we call contribution margin. And from the contribution margin, we subtract the fixed expenses and come up, in this case, with the same $10,000 in net income. The contribution income statement format is for internal planning and decision making. And they're just giving you a warning. You're going to see a lot of this going forward. You're going to see it in the next chapter. I don't know why they're saying we're going to wait till chapter 5. I just want to go back to the contribution format because this is super important. And even though they don't really cover it much in this chapter, I just want to mention something. You sold one item for $100,000. One item, I'm assuming. The variable cost of that item was 60. The contribution margin is thus $40,000 per one unit in my example. Keep in mind that the contribution margin per unit flows right into the net operating income. So if someone said, what if we sold 10 of these things? What would that do to our net income? Well, we know we earn 40,000 every time we make one. So that net income would go up by 10 times the 40,000. Just wanted to point that little relationship out. Companies are always talking about quality costs. Quality costs. These are incurred to prevent defects or keep costs down, improving the use and efficiency of how things are being done. The overwhelming majority of products produced conform to design specs and are free from defects. But no matter how automated your process is, you will have quality costs. You've heard I don't know if you ever heard the expression noise in the system. You have a machine that stamps out a bottle cap every second, boop, 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 boop. And then all of a sudden, on the 10,000th, they come up with a bottle cap that is off spec. And then the machine gets back on the next one and it's working well. It's called noise in the system. You have to be able to distinguish such noise versus a real problem with your process. We're going to talk about preventive costs. These are activities to reduce the number of failures, defects. Prevention costs. You can have training for the employees. You can give them better equipment, make the workplace a little more easier to navigate. Appraisal costs. Here we're identifying defective products before they get shipped to the customer. That's not good. But what's worse than that, when you come up with the news that the product stinks from the customer. Internal failure. Here we made a bunch of sodas, and we sent some finished product into the lab, and the lab said, no, someone forgot to put sugar in here. What a mistake. Well, it's good we caught that now at least. We're going to have a big loss to record because the soda is no good. We just learned that. Internal failure. At least the public never hears about it. But external failures, that's brutal. When you sell this soda to somebody and they take a slug and they spit it out because it doesn't have the sugar in it, you are really got a problem. You're going to have angry customers. You're going to have people walk away from buying from you. So we started with prevention and appraisal. Prevention, training, what they call quality circles, where you set up the laborers, we call it a laborer, machine operator. You set them up in a very efficient way to pick up the material and put it on the line and do all that. Statistical process control, that's a big thing. That's a big thing, where you're measuring how many bottle caps are successfully stamped and when they go out of whack. Appraisal kind of comes afterwards. Appraisal, you can spend a lot of money testing and inspecting incoming materials. You can inspect the heck out of your stuff. You can have 100 inspectors carefully looking at every bottle of soda and taking a sample and inspecting it and culling out the bad ones. But you can never inspect away all of your bad items. It's not possible. That's where the statistical process control comes in, where you figure out if it's noise in the system or some kind of endemic problem. And we just talked about internal failure, scrap, spoilage, rework. You work in a factory, and by the way, when I actually worked for a living as opposed to now, most of my working life was in factories. I liked it. I grew up in central New Jersey, right across from Manhattan. And Purelator, the oil filter company, had a big factory in the adjacent town of Rahway. And I ended up getting a job there for a couple of years. And then I went over to another place, and it was factory work. And I found that I liked it. I was always eventually like the controller, if you will, of manufacturing stuff. Internal failures, scrap, spoilage, external failures. What happens when you ship a bad product? Wow, you're going to probably have warranty repairs to make. You're going to lose sales. You're going to have to spend time and money handling complaints. Not good. Distribution of quality costs. I'm not going to worry about this. Labor costs. Now we're back to labor. And when we say labor, we're talking about direct labor, but what happens if the machines break down or there's a power failure? Well, you're going to be paying people for not working. You may need to work a lot of overtime, and you always have to pay their fringe benefits, their insurance, their 401k matching, idle time, idle. Everybody's idle. They're just sitting around. It can happen for a lot of reasons: machine breakdowns, material shortages, power failures. The labor costs incurred during idle time, we have to call that manufacturing overhead. What happens when the machine breaks down? Well, that was time to break out the mops and the brooms, and you clean up the place and hopefully get a little work out of your employees, but not production work. We know what overtime is. Overtime is always considered manufacturing overhead and fringe benefits. And that's not me, Isaac, that guy there. Hey, the end of the chapter, Isaac, what do you think?
That went by pretty fast.
Would you say not too bad?
Yeah, it went by fast.
Yeah. It's an interesting class. I like teaching it. And like I said, this is the kind of stuff I did. So all right. Well, we started off with just you and me, and we end up the same way, huh?
Yeah.
If you don't have any questions, I'll let you go, okay?
Um,
And we'll see you on Wednesday, okay, Isaac?
not Friday?
What did I say? Wednesday?
Yeah.
Who are you? Yes, I
Monday,
meant to
Wednesday,
say.
Fridays.
Yeah, today's not Monday. Yes, I meant to say Friday. And now I know it's the first class. We won't do any more with 110, okay?
Okay.
Hey,
Thank
you
you.
take care. Bye-bye.